My name is Juno Gonsalves, and I'm here working for Dubai CommerCity for over 3 months now. So thank you all for joining us today. It's wonderful to see such a strong gathering of founders, entrepreneurs, innovators, investors, and our partners. For those who attended our first lobby series session, welcome back. And for those joining us for the first time, we are delighted to have you all here. In our last session, we focused on what investors look for when deciding whether a startup is fundable. One clear takeaway was this: ideas don't get funded, evidence does. Today's workshop is a continuation of that conversation. Before we begin today's session, it's my pleasure to invite someone who has been instrumental in strengthening Dubai CommerCity's startup and innovation ecosystem. Mr. Arjun Sarkar serves as Vice President, Digital Ecosystem and Partnerships at Dubai CommerCity. Please join me in welcoming Mr. Sarkar to share a few words.
A very good afternoon to all of you. Thank you, Juno, for kindly introducing me. So I would not take too much time because we have the experts here waiting to share their knowledge with you, and you are waiting to gain the right advice from the horse's mouth. But to put things into context, why is Dubai CommerCity even doing this and arranging these kind of initiatives? See, Dubai CommerCity always wants to become more than a free zone. We want to be an ecosystem where SMEs, entrepreneurs, enterprises, investors, founders, everyone come together, and we are able to create a community that grows together and eventually contributes back to the economy of this country. So thanks for coming over. Thanks for being a part of this movement that we are trying to drive. And I wish all of you a very, very productive session, handing it over to the experts.
Good afternoon, ladies and gentlemen. I'm Elliot, Head of Programs at Oraseya Capital. Great to see so many familiar faces from the first VC Lobby event that we hosted in collaboration with Dubai CommerCity back in April. This is the second edition, and I believe there's even 2 more before the year ends. So please make sure that you, your friends, your colleagues, your associates join in future if you are interested in the world of venture. From Oraseya Capital's perspective, before I introduce the fund, why we're also contributing to such initiatives and why we're collaborating with Dubai CommerCity on such an event is ultimately because we want to see more and more startups have better chances of success and better understanding the world of venture. Oraseya Capital is a $150 million fund. It's the exclusive VC arm of Diez. And indeed, I'm very, very pleased to announce that we're recognized as the #1 most active fund in the UAE, both in 2024 and in 2025. So in this industry around the world, there's a lot of smoke and mirrors. I'm pleased to say that we're hopefully walking the walk in addition to talking the talk. So today's agenda is as follows. How are we doing on time? We're bang on time, in fact. So thank you again for joining. I'm going to be shortly introducing Oraseya Capital in a bit more detail to give you some more insights on who we are and what we do. Then we're joined by one of our supporters and advocates, IHAN, from an organization called Growth Rhino that we've been working with for 3 or 4 years now. He's going to be leading the session, giving you practical, real insights on what it takes to go from basically ideation to creation, 0 to 1, how you can split test and run experiments. Also in the world of AI tools and the democratized access to experimentation, to tests, and to developing and evolving MVPs very quickly, IHAN will be giving you a huge wealth of insights. Now, today's session is not a lecture. It's not one and the other. It's us. So I'd urge you at any point in time, put your hand up. Please keep it interactive. Ask questions away. Remember, initiatives like this, whether it's at DCC or anywhere else around the world, you get out what you put in. So with that, this is, well, I've never seen a screen behind me so large, but this is essentially the session today. We will be doing our best to stick to time. Naturally, if we go off time or off topic slightly because the questions deviate in that way, like it did last time in April, then that's a positive indication that the audience are engaged. But out of respect to the partners and to the other people contributing to today's session, we will do our best to stick to time nice and tightly so that everyone can get home and hopefully skip all the traffic. So Oraseya Capital, as I mentioned, it says 136 million. That's when we started, but thankfully the value of our assets have increased. So it's a $150 million fund investing from pre-seed to Series B. And this generally means early stage, and this generally means later stage. For reference, our larger tickets at Series B stage are in the realm of $3 million, and our early stage tickets are in the realm of $150,000 US. What's important for you as founders and why Oraseya Capital might be of interest to you if you are seeking to raise funds from venture capitalists is that we are not a one-ticket wonder. We can support your journey throughout and potentially not just invest once, but invest time and time again throughout the journey. Now, I may have shared with you, if you were here last time, a fact of the day which I'm going to echo, which is that the average successful startup and VC relationship is longer than the average successful marriage around the world. And so with that in mind, if you're here at the early stages of your venture and you're seeking Oraseya Capital or any venture capital fund to support your journey for that matter, then you want to think about this line as potentially longer a relationship than that of the one that you have or may have with your spouse. And so in essence, if you are trying to fundraise, you're unlikely to just fundraise on the back of one pitch deck. You're unlikely to fundraise on the back of one interaction, just as you're unlikely to go and get married on the back of a CV. So bear that in mind, and the relationship between a startup and a VC is an important one in your journey, because it need not be one that is only supportive on capital. It ought to be one that is supportive not only in the good times with this milestone and this accolade and this award being achieved, but also in the bad times when this support is required, when this challenge is happening, or when we as founders are struggling with topic X or Y. At Oraseya Capital, we've invested in over 70 startups. In fact, just last week, we closed another 8, and they'll be announced shortly. So you can see that we're very, very active. The way that we conduct our due diligence at the pre-seed and seed stage is in a programmatic fashion, in-house. We run a program called Sandbox. It essentially brings the best founders that we can find together every 6 months into a cohort. Over an 8-week period, we get to know them, their habits, their discipline, their charisma, their clients, their product. We assess their commercials, their finances, their legals. And we host a wealth of workshops and sessions to help upskill them. Then at the end of the 8-week period, they pitch to our investment committee for at least $150,000 investment consideration on a safe note. Now, that runs twice a year, in February and in September typically. Additionally, for late seed through to Series B, if you are at the later stages or the growth stages, we can invest without the need for that programmatic approach on a rolling basis. And as I mentioned, we're the #1 most active investor in the UAE. So I hope that gives you a little bit of credibility about why we're here in collaboration with DCC, and hopefully give you a little bit of confidence that we've seen thousands and continue to see thousands of startups, and hopefully have identified a pattern or two that indeed we can share with you today. So are there any questions around Oraseya Capital, who we are, what we do, or should we jump straight into the content? Okay, no hands. Question? Content, okay, excellent. So today's session is going to be run by Ayhan. It's the first part of the session is go-to-market and traction that attracts investors. Now, the way we're going to run this is Ayhan is going to take the lead, and then I will stand on the side and chime in from an investor's perspective as and when. So again, it's not a lecture, it's not one way. We want to keep it collaborative amongst ourselves, but more importantly, we want to keep it interactive amongst all of you as well. So without further ado, please join me in welcoming to the stage Ayhan Azaz.
I'm going to leave my phone here just so I can monitor time. Hopefully everyone's doing well. My name is Ayhan. I run a go-to-market agency called Growth Rhino. Our focus is we work with B2B software companies. We've been working with Oraseya and Diaz for about 4 or 5 years now, so it's been a minute. The purpose of today's workshop is really to understand what are the right metrics you need from a go-to-market perspective to qualify for funding from venture capital, right? Just so I have an idea, who here is like what you consider a startup? Okay, startups, and how many of you are like early stage versus later stage? Okay, so majority of you are early stage, and is the rest of you just like from e-commerce or CommerCity? Who here is from CommerCity? Okay, so we have some from CommerCity and stuff like that. Okay, cool. So I think we have a good blend of audience. So we've already gone through the agenda. I'll kind of jump into it. So there's this word here called traction. It's a very deceptive word. So for people in the audience, what does traction mean to you? Or as a business owner? Feel free to shout it out.
Gaining early customers.
So customers?
Yeah. Gaining early customers.
Okay.
Revenue.
Customers, revenue. What else?
Length of time in the marketplace.
Time in market. Okay, I can. Sorry, define that. What is it? What do you mean by that?
How long you've been in the market for with regards to what the investor's looking for with history of your business.
Okay. Okay. So time in market. Let's say market share. How long you've been able to keep market share. I see that being a thing. So it's customers, revenue, market share. What else?
Partnership.
Yeah, you can say that. Anything else before we going once, going twice? Okay. So I think those are all correct. I think for different investors it means different things. If you're in a deep tech, health tech, biotech company, you're not going to go get thousands of customers. Like you're not going to be the next Facebook, but you need to get partnerships. You need to get LOIs. You need to get POCs, and that shows traction because of that category. If you're trying to build a marketplace, you need to show certain revenue or certain adoption. If you're trying to build a mobile app, you need to show daily active users, monthly active users, retention, and all that, right? So I think the first thing I tell people is understand which segment you sit in and what are the respective metrics for your segment, right? If you're mobile, if you're deep tech, if you're software as service or SaaS, significantly different. The only thing that matters there is MRR and ARR, monthly recurring revenue and annual recurring revenues, all right? I think the takeaway here is that as you're having conversations, what traction metrics do you need to communicate to the respective investor? It could be you want to recruit an advisor. It could be you want to recruit a key personnel onto your team. Like if I'm trying to recruit a CFO or a CTO or a CMO, I have to go in and tell them about my company, and I need to tell them about the traction I've achieved. Does that make sense so far? Yes, I'm seeing some heads nodding. Okay, cool. Yeah.
Discuss traction metrics right now.
Yeah, we're going to jump into some of the metrics as well, right? So it's a bit weird because this thing, but and I'm blocking. I'm a big guy, so I blocked some of this. But I think in terms of the metrics, I put something called vanity metrics and real signal, and then maybe I'll go through this. But Elliot, I'd love you to chime in on this. It's like there's certain people that just report the number, and it's like a vanity metric, right? So like app downloads by itself doesn't mean anything. If you say, oh, I've gotten like 1,000 app downloads, it's like, okay, great. What does that mean? How many of your apps how many of those users are actually using it, right? Social media followers. If you're building like an e-commerce brand, sure. Unless that number is like 10 million or 5 million, I don't really care. I don't think anybody else will really care, right? Total signups is actually a vanity metric. You can pay for signups. You can go to Upwork and be like, hey, for $5 an hour, go and sign up like 50 times. It doesn't mean anything, right? Press mentions, I think this is important for brand. It's not really important for when you communicate traction to a respective audience, right? And we talked about this. So this is what revenue retention is really important, because I can tell you now, if you're going for certain investment, for me, the number one metric I like to look at is purely retention, because that communicates to me, hey, you can acquire a customer. I don't really care how you acquire a customer. You're able to acquire and keep them. Keeping them is half the battle, right? Acquiring them is the other half, right? Engagement depth, which is kind of like retention, but if you're in the B2C side, you want to see that. If somebody comes and signs up, great, but if they don't log back in 24, 48, 72 hours, it doesn't make sense, right? Referrals and word of mouth, this is, some people call it an NPS score. This is, it ties back into retention, where it's like, hey, we have a really good product, people are using it, and they're referring it. And that is gold, that is pure. If somebody's going and referring your product, amazing. Think about all the apps you use, Deliveroo, Careem, Talabat, all of them have a massive, those companies organically grew because of the referral mechanism, okay? The last one, this is more on the sales front, if you guys come from B2Bs in general, is pipeline quality and close rate. If you're trying to go and close a $2 million, $3 million deal, that's not happening tomorrow. That's a 60, 90, 180 day sales cycle, right? So this is like really the signals. From your perspective.
Yeah, from my perspective, I would add 2 points. The key thing here is, number one, speak the metrics of your industry. If you are building an e-commerce business and you start speaking about shoe sizes or the number of people who visit your store in person or anything completely unrelated and random, then it doesn't invoke a level of confidence and conviction from an investor standpoint that you understand the levers available to you in your industry. I'm just going to elaborate on that. When you go to a concert or a nightclub or something similar, a DJ has what I understand to be all sorts of buttons and knobs and things like that. I don't know anything about DJing, but what I do know is that there's a huge skill set in understanding and reading the room and the vibe of your audience and playing and adjusting the lights and the smokes and the tempo and the pitch and the volume, as well as the song's choices and the mixes to match and to influence the vibe of the audience. The same metaphor can be applied in a startup. You need to know which knobs and levers and buttons you have available at your disposal to experiment with. And if you don't speak the metrics of your industry, it's obvious from basically moment zero. The second thing I would say, to complement what Ayhan has shared, is that from an investor standpoint, whilst the epitome of the best type of traction is recurring revenue, people coming back monthly, like a Netflix subscription that you blindly pay, whether or not you're watching your Netflix shows, what we are looking for is velocity. So there can be merit in some of these metrics, these vanity metrics, that look good but have a little signal if they're growing. We want to see a growth in that velocity. So from a day in, day out, your waiting lists get longer. A day in, week out, there's more people on your website. But it doesn't, in isolation, it's not enough, which is why the real signals are that people are not only coming to your e-commerce website, and there's more and more people coming to your website, but there's also more and more people returning to your website, and more importantly, more and more people converting on your website. So the velocity is very important. If you just share that we are this and our conversion rate is X% and this is how much revenue we have, that is an isolated moment in time. What's important as a founder is that you communicate the progress over a period of time, ideally 3 months or more. And if you haven't got the recurring revenue in month 1, 2, and 3, maybe it only comes in month 7. Well, there are metrics here that contribute and lead towards this, the recurring revenue happening in month 7, such as social media followers. Again, not important, but a good indicator. Are people paying attention to you? Website visits, newsletter signups, waiting lists, pre-selling a product. It's one that in e-commerce particularly people always overlook. Can you perhaps sell your product in advance before you've even distributed it or you're prepared to get it out there? And referrals. Perhaps people have referral codes that they're sharing with their friends, so that virality effect contributes to the momentum and attention that you're building up. All of these things may contribute to what the recurring revenue happening in month 7, If you haven't got recurring revenue, my message is don't worry about it, because all of these other efforts, providing you're showing growth and you're showing a velocity, the gradient increasing steeply of that growth pertaining to metric X or metric Y, will indicate that you understand the levers available to you, and ultimately when the recurring revenue happens in month 7 in this example, there's good conviction that that growth of that you've experienced from month 0 to month 7 can continue even more from month 7 onwards, where it matters most, which is monthly recurring revenue. I hope I managed to make that nice and clear. Sorry for rambling. Please.
Can I jump into further details about the business model? So as an example, we are working in SaaS-based business model. So economics of that business is completely different from, let's say, e-commerce industry as a whole. So how would you counter that in terms of ARR or MRR?
Well, no, so you're right. It's a good question. And if you're in e-commerce, your metrics are significantly different if you're in SaaS. In e-commerce, it's more about, okay, active customers, maybe you have recurring customers because they have subscriptions also. Don't forget, SaaS replicated e-commerce with subscriptions, right? With mailing and stuff. So if you need to communicate the right metrics. Now, I think the key thing here is any investor or any person you speak to, if you present 8 metrics, they're gonna be like, whoa, what are you talking about? This is data overload. You need to identify the 1 or 3 metrics that's the most important for your business. So if you are in SaaS, it's ARR, MRR, granted. If you're in e-commerce, it is how many, it's usually GMV, right? And then how many active customers, so you know what's the average order value per customer, right? And then the repeat purchase. Because with e-commerce, you don't make money usually on the first. It's always on the follow-up. If anybody looks at their Amazon accounts or anything equivalent, you look like the vast majority of it you see is on the repeat. Amazon's not spending money to reacquire you. They might be spending money to just like remarket to you here and there, but you've already been acquired. They just want to make sure that you're using the product, okay? So to your point is you need to know which metrics are important to you, but to Elliot's point as well, if you know these are active investors in SaaS, knowledge is infinite, right? Like you already know what are the 3-4 metrics. It's going to be MRR, ARR. If you're doing enterprise SaaS, it's going to be your pipeline value. These are the things you need to communicate, okay?
So a couple of things that we are stuck with, I'm just asking the questions about what we are facing right now. So variability of business is very important in today's world in SaaS business model because of AI.
Okay.
So revenue is going up and down because of that. So let's say if you're signing up for a particular thing, you don't know the token usage per month.
Okay.
So how would you factor that in when you are doing your calculations for the investors?
Well, I think that's the purpose of the metrics, that will come up in the metrics, right?
Is there any particular metric that you
Let's circle back on that if that's okay, because I'm going to address some of this in there. But I think one thing to take away from this is definitely know your industry and what are the respective metrics. And if you don't know, it's one prompt away from any search tool to understand what is the right metrics for that industry. You know, it's usually B2C or B2B. And if it's in B2B, it's a self-service or mid-market or enterprise, okay? One other thing that he mentioned that was really important is when you're looking at these metrics, don't look at it in a snapshot. If you close somebody today and you were prospecting them for the last, 3 months, at this current thing, my growth rate could be like 100%, right? Because I'm only looking at it from like the last 24 hours. It's very important that you take these metrics and you put them on a timeline. Very rarely, like you can do, if you're B2C, you can do daily. The vast majority of what investors want to see is like, well, are you consistently growing these metrics over a period of time? 1 week, 3 weeks, 4 weeks, a month, a quarter, whatever, okay? This is really important to capture. I want to go over the next slide because I think it's the next 2 slides, which is very important. Growth rate. So we talked about this. You'll see this all the time when you're speaking to people, and these can be. I'm blocking some of it, but it can be very misrepresented, right? Because what this means is like you'll speak to some startup, oh yeah, we're growing like 50% month over month and stuff. They just started 3 weeks ago. Obviously they're gonna grow 50% over month. You're starting from zero, right? So that's not a meaningful number. If you're like 2 years in and 3 years in or whichever, and you're growing 50% month over month, it's like, whoa, okay, that's a different story. And don't forget, people also prorate certain things or they annualize it, right? So it's like, hey, I'm growing like 60% month over month. Like if you close someone, especially in B2B SaaS, right? And let's say it's 1,000 dirhams or $1,000 per month. I am never taking that 1,000 dirhams or $1,000 per month, and when I communicate to the public, I say, hey, I have a $12,000 recurring annual consumer, right, or it's a business, right? That impacts your metrics because now you go from being whatever $0 ARR company, you go look at your first customer at $1,000 per month, you're $12,000. So now when you communicate to the public, hey, you're a $12,000 ARR company, you're like, whoa, okay, cool. That changes the dynamics of it. So growth rate, be very careful in how you communicate this. This has to be over a period of time, and it has to make sense, right? I talked a lot about retention. I don't think enough founders understand retention for some reason, but retention is probably the most important metric across B2C and B2B. You know, if we really talk about growth and traction, whichever, growth by definition is retention. You're not able to grow if you're not keeping your existing customers. Sure, you'll lose some. You're not, very rarely in a software world or in a consumer thing, you'll be at 100%. You need to hover around, in software, you need to hover around between 70 to 80%, right? In consumer, you're probably at 60 to 70%. But if your retention rate is south of that, you have a big problem. That means your product is bad and customers are not staying. And that's a massive red flag. So I can look at any company and the first question I ask them is, what's your retention rate? And if they tell me anything south of 50, I'm like, you have a product problem, right, straight up. You don't have a very thing, yeah.
But that'll depend on industry.
It will, sure, we're splitting hairs there, but Jen, if somebody comes to be like, my retention rate is 30%, I mean, that's a service business. You know, my retention rate is between 30 to 40%. It's a transactional business though. If you're building product and you're building software, that needs to be north of 60, right? For B2B enterprise, you're at 95%. If you're not at 95% at B2B enterprise, something's wrong. Because you spend 2 years acquiring them. Think SAP, think Microsoft, think Oracle, right? Think Salesforce. These guys spend years putting it together, and if they churn after 1 year, that's why you have multi-year contracts and everything, right? Anyway, I'm good. But retention is really, really important. Evidence of pull, we talked a lot about different ways to communicate that, but like our customers really interested in you and what you're doing and everything like that, right? Believable path is more like the narrative you stitch together, but you know, can you really communicate to your customers and vice versa on how the activity is like in that. And capital efficiency, this is a little bit more advanced, right? What this means here is, you know, how efficient are you at deploying resources, right? So let's say you're bootstrapped. You're like, hey, I'm going to take the venture. I'm going to take the lead. I'm going to pay it 200,000 dirhams or $100,000 into the bank account, and I'm going to go hard. I'm going to try to be as efficient as possible to launch this venture. If you spend like half of that just on PR and marketing and on blitz, and you burn through that, that's not very efficient. It's going to show up in your due diligence. They're going to pick it up and be like, we're not investing in you. Makes no sense. This guy could, or this lady cannot handle money. Like they don't know how to deploy it, okay? That's a bit of a more mature way of looking at it, but the reason I bring it here, let's say you're an e-commerce company or a B2B software company. You want to spend money on Google Ads. If you don't know how to experiment or how to deploy capital for Google Ads, that's a red flag, okay? Does that make sense for everyone? And why I put it here, around from a metrics standpoint, it's like, how are you spending your marketing dollars, whether it's your own money or venture money, into it, right?
Can I just chime in?
Yeah.
Just to chime in here, guys. The capital efficiency piece is very important. It showcases a level of frugality. We want to know that the founders that we're investing in are not basically, wasting away money unnecessarily. They're being very conscientious about how they spend their dollars, how they spend their time, and ultimately what the outcome, or the potential outcome of that. So everyone thinks about ROI, return on investment. I think I mentioned this last time. You want to also think about ROTI, return on time invested. So if you are very diligent and protective over your dollars, but also your calendar appointment and your time, then essentially you're going to be achieving much more because you have less distractions, you're much more focused. When you take on venture money, consider the terms associated to that money more strict than if it was your own parents' money or your own friend's money. Because the terms, when you take on venture funds, always favor the investor. And then they favor the founder secondary. So I'm giving a little bit more of an elaborate insight here, but essentially, if you can, even if you haven't got monthly recurring revenue or annual recurring revenue yet, and you're on your way with all of the other indicators that I alluded to before, if you're showcasing a level of capital efficiency that is frugal, that is proficient, that is professional, that is not wasteful, that is resourceful, and or showing a level of frugality on your time and being very diligent about how and why you're spending your time doing X and not Y, that's a very positive sign. Because we know that there will be storms. We know there will be difficulties when we invest. The question becomes, can he or she weather the storm? Do they have the resilience, the grit, the determination to be able to weather the storm in a capital efficient capacity and then come out stronger at the other side of that storm? And that storm could be weeks, months, or even years long. And if the answer is no, well, thank you very much. We'll look at the other opportunity where they can perhaps do so. Does that make sense? Thank you.
Cool. You may need to chime in on this one as well,
Yeah,
but
sure.
well, I'll just quickly go through it. So we talked a little bit about traction signals and everything, but I like to break it up. Most of you are sitting in the pre-seed and seed. I doubt if you're in this workshop, you're at Series A, but I think it's helpful for you guys to know. Okay, pre-seed again is like pre-idea. I'm at idea stage. Where do I go? I think Oraseya is pretty much investing in between 1 and 2. Okay, so if you go to them and then keep in mind, like I've been in this space for about 15 years. I don't look it, but I'm a bit older. Okay, the venture space has changed significantly. 7 to 10 years ago, you could go into a room and be like, you know, I'm this person. I've identified this problem. I want to build a product for it. Please give me money, and you can raise on a pitch deck. That is gone. Those days are, unless you are like a very well-known figurehead or whatever, and you're building something that's very complicated that requires significant capital in deep tech or health tech or biotech, sure. But for the vast majority, you need to come into the room if you're planning to raise venture capital, right? With a certain level of traction. Otherwise, it doesn't work. Right? So that's the first thing. You need to come in, and depending on your stage, that's kind of what, like, these are the different ways, which I'll talk a little bit about, right? But before I do this, I think, Elliot, it just hit me, like, not all of you are right for venture capital, right? And I think I would really encourage you to think, like, okay, is this a fundable business? Great. Is it a profitable business? Even better. But is it a venture fundable business? And what I mean by that is when you take on venture capital, you're taking on somebody else's money, right? You have a responsibility to kind of grow that. Obviously, if things go south because of economic conditions, that's not your fault and all that, that's separate. But when you're taking on another person's money, the expectation is if I give you money, it doesn't matter if it's an angel investor or if it's Oraseya's money, right? Is that you are expected to grow that, and you're supposed to protect that capital and then grow it by 10, 20, 30, 40, 50%, whatever you've committed, right? And that's a big responsibility. So most of the businesses I see, you know, there could be tech-enabled businesses, services business. I'm like, great business, not venture fundable. Generate a bit of revenue, go to ENBD, get a loan, and grow that business. Because you're not taking on anyone's headache. It's way faster to get that. WIO even has like instant money on the thing if you, as a business owner, if you're generating revenue, right? So there's other ways to get capital. VC is actually a very expensive way to get capital sometimes because you're giving up equity, right? So not all the time you should consider venture capital, right? I think that's something I've seen a lot as well. But let me quickly go through these. The traction by stages at pre-seed, you want to really show problem validation, right? So that's like, okay, I went and identified this problem, like, co-working spaces have this problem. I've had like 100 interviews. This is what they've said. I have some design partners committed, letter of intents. Maybe they've given you some money, like, hey, this is a big enough problem. Here's $100 or whatever. You're trying to give some sort of signal, right? And then, if you have a wait list, it's like, hey, we have a wait list, but we've been communicating the wait list. Look at the open rate or whichever. This is pre-seed. This is pre-ideation. Like, this is a very, very tough space to be in to raise money, but it can happen depending on different dynamics, right? But the real goal in pre-seed is to just validate and say, hey, this is a problem. I have a solution. I validated the solution a bit. I don't know if it's a scalable solution, but I validated the problem and I validated the solution. I need money to kind of take it to the next level, and I forecast and I predict if I build a scalable solution, there's a potential $1 million or $1 billion opportunity, right? If you guys are coming and be like, oh, I'm going after a niche market and there's only like 500 of these people that are there, and like, I'm like, okay, this is not a venture fundable opportunity. Venture fundable, and Ali can maybe talk about this in a bit, but like, they want to see like markets that are massive. If you're saying I'm only targeting like radiologists in the UAE that have 10 years of experience, I'm like, dude, your market size is like less than 50, right? Like, what are you talking? Like, you're not going to build a big enough business for that. It could be a great service business. It could be a good lifestyle business. 50 people, 1,000 dirham thing. You could be at 50,000 dirhams a month. Great, but it's not venture fundable because they cannot. The ceiling is at 50,000, right? Let's talk a bit about seed and Series A. Seed is when you've gone and be like, look, I have the problem, I have the solution, I validated, I'm generating a little bit of revenue. I might have 5 to 10 customers, at the B2B side. Maybe on B2C, I have maybe like 100 to 200 or something. Like, I've got something going. Then we start to see, okay, we have retention, but it's starting to flatten, meaning like, okay, people are using the product, I'm getting some feedback, everything, right? And then you're this is harder than it seems, but you're getting to this notion of a repeatable acquisition strategy, right? Meaning I know how to acquire my customers and I know how to keep them, right? Then at the Series A, it's like, hey, we're growing consistently 20% month over month. We need capital to deploy it. We know exactly where to deploy it, right? Very rarely when you have a Series A company, they don't know what to do. They're like, no, we've gone through the company building journey. We know exactly where you can go, right?
So, in essence, if I was to summarize, what perhaps was sufficient for seed is now being demanded at pre-seed.
Yes, exactly.
Even previously. I would say perhaps yes, and I'll elaborate on this, and I'm sure Ayhan has some commentary as well. If you look at the world of venture in the past 20 years, particularly the past 10 to 12 years, there was a lot of hype rounds. Unicorns being built within 6 to 12 months. Pre-revenue startups receiving hundreds of millions of dollars in funding. And many of those don't exist today. So as a result of that happening perhaps at this stage of the spectrum, the ripple effects trickle down and increase the requirements to this stage of the spectrum. And that's largely unfair, right, for the small guys starting out. But it is the reality of the investment landscape today. However, it is a good thing, I would say, because this is not a charitable affair. This is not a let's splash loads of cash with no clear return on that cash or return on the investment affair. It's a let's invest to make exceptional returns. Ayhan mentioned 10, 20, 30, 40%. I would argue it's 10, 20, 30, 40x what we're expecting, sometimes more. So with that said, the demands at pre-seed, although you may not have revenue yet, are to showcase resilience, grit, determination, and in your charisma. the ability to listen to your market, have strong feedback loops from your customers, the ability to experiment, and I'm sure we're going to spend a bit more time on that later this afternoon, and importantly, the ability to be capital efficient and not just spend money or time on things that don't actually shift the needle. You can do all of those things at Series A, Series B, or Series C, but you can also do them and have more impact on your business at pre-seed. So that's most likely why. The other reason in the past 15 years or more is that technology has become much more accessible and it democratized the level of accessibility. So it isn't just around, defensibility now isn't solely around your code base. It's also around your speed to market. It's also around your execution ability. And consequently, the ripple effects of a lot of funds losing money, a lot of hype rounds returning nothing, and accessibility of technology being made more available to earlier stage founders at a much cheaper price means that the demands on the pre-seed and the fundamentals of said opportunity are tighter and more rigid than in the past. At an institutional stage, okay, I want to caveat that. I'm going to wrap this point up quickly. Here, let's imagine this is a chart, this is a line. Perhaps here, you invest yourself, then maybe your friends and family, then perhaps your friends and family's friends. Do you know what I mean? Like maybe they have a wealthy colleague or they know an angel investor, but you don't know them directly. Then here somewhere, an angel syndicate. So perhaps a lot of angels put $1 million together, 20 angels do that. The syndicate fund is now $20 million. Then an institutional fund like Oraseya Capital that would invest at the early stage. And then later stage institutional, and possibly beyond Series A, somewhere over here, private equity funds. The important thing that remains consistent here is everything I shared. Grit, determination, resilience, feedback to your market, capital efficiency, closeness and proximity to your customers. So if we can see signs of that here, it gives us confidence here. Because remember, we're not in the business of investing, we're in the business of exits. I shared that, I think, with you as well, you were at the previous one. Yeah. We're in the business of investing here, in the best that we can find, and hopefully one day exiting here at a 10, 20, 50x multiple or more. And if you can showcase those traits that I alluded to, whether you're there or there, then it de-risks the opportunity. And that's a combination of why I believe the pressure of perhaps what was expected here in terms of traction and metrics is now being requested here. And by the way, it's forcing entrepreneurs to level up. They become much more competitive. At Oraseya Capital, we're sector agnostic. So we can invest in a health tech or an AI or a fintech or an edtech company at early stage or at later stage. But certain VCs are domain specific. They only invest in, for example, female-led Arab founders at seed stage, building edtech. That might be their thesis. So then you, as a non-female, non-Arab, non-edtech, later stage founder, would not fit their thesis, for example. And so you've seen these market adjustments. That niche thesis may not have occurred 15 years ago, but because of all these hype rounds, the niche often represents a better understanding of VC and founder fit, a better ability to help, a better ability to support and follow on, and on the contrary, offers a smaller pool from which to select. So, with that all said, I hope that answers your question as to why I believe that the requirements or the pressures of pre-seed stage have increased drastically. And if you don't keep up, you're not going to get to that stage most likely anyway, but also earlier stage investors can look elsewhere.
So on
Does that help? Does that
Yeah,
help?
thank you a lot. And actually, your last session, when you spoke about the risk approach, so that's exactly what you're talking about right now. So that's why it's moving to your stages.
Exactly. It's not like a charitable affair. It's a, does this gentleman or does this woman or does this team in front of me have what it takes to offer the most potential upside with the least potential downside? And it's not a simple yes or no. There's many factors that contribute to that.
Thank you.
No, you're welcome. I'll just take this gentleman first.
I was just going to say quickly, with regards to obviously Series A, is the expectation now, on that note, that Series B expectations will be met, all be questioned in Series A and below?
Yes and no. Okay. Do you know what the weather is going to do tomorrow?
Well, nobody does.
No,
But
exactly.
there's
Exactly.
ideologies there
Yeah.
to select what the weather pattern's going to be.
So I don't know what the weather's doing tomorrow anyway, as well. I have a forecast, but I don't know. So how on earth can I know if I'm investing in Series A, expecting you get to Series B within 24 months,
Yeah.
what that Series B is going to look like
Yes.
nearly 700 days later? I don't. But I can gauge, does he or she or they have the conviction and the ability to navigate their plan? Is their plan convincing in an okay/best case scenario? And or do they have the grit and resilience to navigate in a worst case scenario? And a very important, and that, the essence of gauging that applies just as much here as it does here, as it does here, as it does here, as it does here, because we're not looking to lose, right? So, do you need to be speaking about your Series B at pre-seed? No. Do you need to understand the business of VC? If you're approaching VC investors around about here, yes. So if you're able to discuss cash flow, runway, capital efficiency, forecasts, maybe when you're here, you're already having conversations and teeing up the dialogue here so that in 12 or 18 or 24 months, they're ready to execute, you're keeping them updated, then that's a positive sign. Does that help?
Yeah, it does.
Okay. So,
Thank you very much, very helpful.
okay, no
For
worries.
how long you need to be in business, when you do evaluation at Series A? Like how long you need to analyze to consider that this business qualifies for Series A?
So the analysis itself can take a matter of weeks. Is that?
No, I mean, for how long the business has to be operating to prove that it's a system,
I guess, how do you
It's a
categorize a
system.
Series B company?
Yeah, to be honest with you, that's a really subjective question.
Mm.
What I might call pre-seed, I might call a friends and family round. What you might call Series A, I might call a seed. So I'm not too worried about that. But I'm going to, about the title. But what I'll try to do is give you an indication as to how and why one round is differentiated from the other. The pre-seed and the seed round are typically executed on what's called a safe note. It's a convertible instrument. I'm not going to go into it today, but essentially it allows, SAFE stands for a simple agreement for future equity. It allows investors to come on board, you don't issue them share certificates, and then eventually once you issue share certificates, which could be 12 months down the line, or 18 months or 24 months down the line, the future equity, SAFE, the future equity, converts into actualized equity, into a share certificate. So all of this is rounds done or funds raised on safe notes, on convertible instruments. Typically here, Series A onwards, those safes convert and it becomes an equity round. Now, if you've done one or two of these and your first batch, let's say two, your first batch of safes is at a valuation cap of $2 million, then your next batch of safes, 12 to 24 months later, is at a valuation of $10 million, for example. Then we started to see some real upside, and on paper, your investors have made 5x in that time. Here, depending upon your industry, depending upon many other variables, you may be raising considerable amount of money, perhaps $10 million, at possibly an $80 million valuation, for example. So the amount you're raising and the valuation is substantially different, so that's one indicator. Whether you've done safe notes at different valuations in the past is another indicator. And then typically this is an equity round. It's another indicator. So I guess that would probably answer your question in one capacity or another.
Is that, guys, this is very simple. High risk, low risk. If you have $100 right now and I tell you, hey, pick, you have two options to pick. You're gonna pick on something super risky. You don't know if it'll work out versus something that might work out, right? That's the name of the game here. As Ellie just monologued there, there's 20 different metrics he's looking at. The thing you said, which was interesting, is investor confidence, and he briefly mentioned is who else is investing, right? This becomes a little bit of a school club or closed club towards the end, you know? Oh, Oraseya, if Oraseya is putting money behind it, I already know because of Elliot, the brand and stuff, it's already gone through due diligence. I don't have to put in that work. I'm like, okay, how much are they raising? 50K? I'll put in the 50K as that, right? Sharuk partners are putting it, then okay, Elliot will come in. So a lot of this stuff de-risks at that time. At this stage, it is. To your question at pre-seed, 5 years ago, you needed, I need to build a product, I need 5 developers, I need this, I need that. You need to build this kind of ecosystem. AI has changed that. I've built products personally in 2 weeks that were better than my own clients' products. Right? And that's because I can move 10 times faster than there. So I question what you need the money at. And if you can't close a certain investor, that also shows your absence of sales and your acumen of being a founder, right? In my opinion. Right? Mine's a bit more aggressive. It's like, look, to close it, if you want to close a pre-seed round, you need to tease the opportunity. Hey, this is $1 billion opportunity. I've built a scrappy product on Replit for $1,000 and I've gotten at least 20 customers in 4 weeks. That sounds like a good opportunity at a very high level. Let me investigate further. Okay, what are the metrics? It's good. And so that's how you get the conversations going. At Series A level, to your point, very different. It's like, what does your unit economics look like? Which kind of brings me to these things. What are the core metrics, right? We talked about some of this, but like, what's your MRR and ARR? What's your monthly recurring revenue? Is that growing at Series A? Is that growing or decreasing? Very important. What's your CAC? What's your customer acquisition cost? Are you spending $100? Are you spending $1,000? In B2B enterprise, you're spending $10,000 to acquire a customer. That's not including salaries and office, purely between marketing and like taking your clients out for dinner and conferences, and you're spending up to 10 grand. Some people spend up to 20 grand. If it's a customer that's going to pay you $2 million a year, what are you willing to spend, right? LTV, very, very important. Lifetime value. If there's one metric you need to learn, it's that. You know, what is the lifetime value? If I acquire you for $1, how much money do I anticipate you spending with me over your lifetime? Your lifetime is not going to be 100 years. Generally, people do 3 years, 5 years, 10 years. Like 10 years is a stretch. I would do 3 years as a base. Over 3 years, how much money am I going to make out of you? Going back to e-commerce, what's the LTV? Like, our LTVs on Amazon are really high. That's why Amazon's a unit, like it's crazy value. Because once we spend on Amazon, we're going to keep spending. And our LTVs now, Amazon's been around for what, like 15, 20, 25 years, right? Our LTVs are going to be in the tens of 20s of thousands, you know, as a consumer, right? Payback period's a bit more technical, but what it says is, if I spend $10 to acquire you, and you're only spending $2, how long will it take for me to make my money back until I break even on that, right? So if I've spent $2 to acquire you, and then but your LTV is $8, then it's like, okay, fine, in 2 years or something, I would have had my payback period. That's a bit more technical, but you can start to calculate it. Retention and churn, we talked about how often do you keep a customer, how often do you lose a customer, right? Yeah.
So what's the ideal LTV to CAC ratio for?
It changes per thing.
For SaaS-based business model.
For SaaS, you generally again, let's take a step back. What's good for you or what's good for him?
What's good for him?
For you, Elliot, what's a good CAC to LTV ratio for you?
Honestly,
He's the investor.
a question like that is, the answer unfortunately is, how long's a piece of string? It's very difficult to, we're not evaluating a metric in isolation. I already mentioned that. So if I said a good CAC to LTV ratio is 10 to 1 and you have 11 to 1 and then we don't invest, you'll be like, yeah, but hold on, you told me it was 10 to 1 in that workshop that we did. And I've got more than that. You're like, yeah, but it's not in isolation. What we want to see is a combination of things, which is $1 in equals more than $1 out. Okay, so you're spending $1, you get more than $1. If it's 2, 5, 10, 20, brilliant. We want to see retention. So $1 in gets you $10, but actually 70% of your clients are churning after 2 months. It's not a predictable revenue. It's got a lot of leakage. There's a business, for example, the ready meal business, where they deliver meals to your house. That has like an average of 75 to 80% churn monthly. And people are okay with that based upon the fact that they can plan for that. So anything that in that industry has a churn that is lower than 75% is considered exceptionally good. But in your industry, you'd be like, I would never be satisfied with a 75% churn, for example. So ultimately, that's
I can give you the
that's where I would suggest.
From a marketing standpoint, typically when I speak to clients and stuff, I'm like, hey, your CAC to LTV ratio needs to be at minimum 3 to 1. Minimum 3 to 1. Meaning, if I spend $1, I need to get $3 out of you in some given time period. Ideally, you want to aim for 5 to 1. Meaning, if I spend $1, I need to get $5 out of you, right? If you're at the 10 to 1, and you guys can go and research your competitors, you can use AI to figure this out. What should my CAC to LTV ratio be if you're bootstrapped versus venture funded? If you're venture funded, you have to 3x that because they want returns, right? So we talked a little bit about this. I'm just being cognizant of time. We're already at 3:30. The thing with traction is that it's a moment in time. It's not a single snapshot. So you want to be able to communicate your traction for the week, for the month, for the quarter, for 6 months, for a year, for 2 years. Those are all going to be very, very different. So what's important for you is to understand that piece of data and understand how to communicate this to your stakeholders. If your stakeholders are to angel investors, they might not be super specific, oh, I want to see 10, 20% month over month growth. These guys are. They do quarterly reports. As a founder, if you take their money, you have to report. You're reporting. You have you don't have a boss, but you have to go and tell them hey, how are your unit economics? How are you reporting? Are you growing month over month, right? Because I think this is really important. The last, you can't really see it, but and Elliot's already talked a lot about it, is they're looking for patterns. As a founder, are you able to achieve your goals that you set, and are you able to maintain those goals and hit your KPIs, right? You the founder job is not an easy job. It's actually extremely complicated. You're doing a little bit of finance, you're doing legal, you're doing customer development, you're doing product, you're doing marketing. It's all 6 or 7 jobs in one thing. It's not easy. I think a lot of people, they're like, oh yeah, I'll just set this up and I'll do a little bit of this, a little bit of that, boom, $1 million. It's this never happens, right? So I think it's really important when you consider traction, you have to understand what it means to you and what it means to your stakeholders, right? So I just want to be cognizant sometimes. Maybe we can skip this, but I'm happy to take 1 or 2 things. It's based on your business, what is the one metric you want to track today? Is it vanity or signal, right? I think the goal here, depending on your industry and what you've learned, maybe if people can shout SaaS guy, what are the metrics you want to be trying? You're still monthly recurring revenue, right?
We have, but again, that's changing on token usage.
Potential. Well, to answer that question, it's very simple. Go and look at what the big boys are doing. If you go look at Clay, Replit, Lovable, all of them, Anthropic, how are they managing that? It's simple. You have a base price, $20. All of the AI tools, $20. And then you have a consumption spend, right?
Yeah.
It's not that hard. Once you do the $20 base, okay, 20 times 1,000 customers, you have 20,000 MRR.
But that's where the model is changing overall. SaaS is, yeah.
So that's your base recurring. And then once you have a user going and using so many tokens, you can easily look at that and be like, okay, over the last 3 months, this user group is on average spending this amount. I can add 2 to 3K to that thing. And that's how you get that number. So then you're like, okay, my average customer is spending about 2 to 3K in MRR. And then I have around roughly 50. So you can say, hey, my base is like maybe 10K in MRR, but if I include my variable, I'm at 50. You're like, oh, okay, cool. So that's AI pricing and stuff. And that's to your point. In your case, if we're talking purely traction and metrics, you need to, again, you're not going to get traction right now. You just started. What are the right metrics you need to track? You need to be tracking customers, consumption, activity, retention. These are the metrics that you need to be tracking on a daily basis. I think what's important, the reason for this exercise is that now that you know these metrics exist or how important they are, you need to make sure you're tracking them from today so that you can report on it and be like, oh wow, like look, we tried all these experiments, it didn't work, but we did this thing, boom, there's a hockey stick growth here. Why? Let's investigate. Make sense?
It makes sense, but still a little needs to be explored in terms of evaluating enterprise customers and.
For sure, yeah. It's not a one and done thing, right?
One size fits all.
But I think the point here for everyone in this room is there's metrics you should be tracking. I don't care how you track it, if it's on an Excel sheet, if it's on your phone. Ideally, your product is reporting it, but you should be tracking a metric on a daily, weekly, monthly, quarterly, annually basis. If you don't, it shows kind of like the inexperience you have as a founder, okay? And a lot of time this stuff is readily available. You're already sitting on this data and you cannot report back on it. It just shows you don't have what it takes, right?
Four things that we track is ARPU, then
Yeah.
DAUs and MAUs,
Yeah.
then paid users versus on the total users that we have, and then
You should also track conversion from free to paid.
that's right, paid users versus on
But the
total.
conversion, what's your conversion from free to paid?
Okay,
That's important
that
because
is itself the number of paid users in a month.
yeah, but
on total
there's a
users.
percentage then, because then right from there,
Yeah.
you can diagnose, okay, what's happening in the product, and that's
Yeah.
where product marketing comes in.
Correct.
Product marketing can influence that particular metric
Free users
from free to paid.
Okay.
If you have 100,000 free customers, but only like 1% is on paid, you're like, oh my God, that's a horrible conversion rate. But I'm acquiring customers, but I'm not communicating enough value to convert them into a paid customer. And then that becomes a whole other issue, right? How are we for time? I think we're running a bit. It's 3:40. Okay, I'll try to pace myself, and I'm gonna go into go-to-market. Before I go into go-to-market, anything, Elliot, for metrics and stuff you want to wrap up with, or?
No, I don't
Okay.
want to. I think
Okay.
we've got to be conscious of time.
Yeah, I'm gonna.
Well, let's ask the organisers actually. How are we doing on time?
Yeah, we need to rush a bit.
You want to rush? You want to take a break? You want to adjust?
Sorry, yeah.
We can take a break in between, it's okay.
Yeah.
Can I ask one question?
Yeah. Hey, how about you and I have a one-on-one while everyone else has a break? Yeah.
Okay, so let's take a restroom break. Reconvene in 10 minutes.
Yes.
So thank you for listening. See you guys in 10 minutes.
I use this word a lot, go-to-market. What does go-to-market mean? It's essentially how do you go into a market and acquire customers, right? And as fast and efficiently as possible. There's 3 components to a go-to-market. You know, who's the ideal customer profile, known as an ICP, or the persona, the positioning, and the problem message fit. You need to figure out all 3, okay? So let's talk about the ICP real quick. It's basically who's your ideal customer. Is it radiologists in the UAE? Is it radiologists in the UK? Is it medical professionals somewhere else? Whichever it is, okay? Understand who your ICP is really, really, really important, and then figuring out from there, right? The reality is you probably don't, at pre-seed and seed, your ICPs, you're gonna have a lot of them, it's gonna change, there's a lot of different mechanisms of it. Then we get into positioning. I think everyone in this room knows what positioning is. It's how do you position your company for your ICP, right? Positioning is it can be complicated, but it can also be extremely straightforward. Meaning, what's the value proposition for your product or service for your ideal customer? Is there a time value or time saving value, or is there a revenue generating value? That's essentially what it comes down to. When I release a product in the market, it's either I'm helping you do something faster and more efficiently, or I'm helping you save money or make money. You know, you kind of need to put yourself in one of these three. If you look at any of the other stuff that you guys use, it's either making you money, saving you time, or saving you money. Falls into one of these three buckets. You know, I use Deliveroo. Why? I don't want to go waste time ordering something, and I like the convenience, right? Essentially, it's a time value proposition. Problem message fit. This is something you're going to constantly experiment and iterate on. And what that means is like, how well are you talking and speaking about the problem, and then how well are you somebody's Teams is it went away. Yeah. The problem message fit is how do you keep figuring that out, right? The easiest thing you can do in this case for problem message fit that I tell a lot of people, especially with the use of AI, record all your customer conversations with consent and everything, download the transcript, upload it to any LLM, and be like, hey, in the last 10 or 20 conversation, what is the recurring problem that I've seen? And you want to use your customer words from it, right? If you put all of these three things together, you will have a decent go-to-market. The only thing that you need to pick is the channel, which I'll talk about, right? Sorry, this is buzzing a lot. Arsha is messaging you. So nobody faces parking issues, just FYI. Okay, so you need these three things plus a channel. That's it. If you can figure out these three, you'll be way ahead of you. And it's fine because these are going to change. But the fact is you need to keep trying. Does this make sense? This is fairly basic, but it's like kind of like marketing 101. Okay, who are you reaching out to? How are you being positioned? And what's the message? Right? Are you positioning against competitors? Are you being positioned? Are you in a new category? Whichever. Okay? Each one of these are their session on its own, but I just want to kind of give you broad strokes there. Okay? Now, very, very, very important. If there's one thing you take away, please pay attention to this. What is your go-to-market motion? Founder-led, product-led, sales-led, community-led. Okay? I'm going to break this down for you for each time. Founder-led is that it's everything you as a founder. You are the best salesperson, the best representative as a company. People are buying your product or service because of you. This is very common for professional services business. Right now, if somebody engages in Growth Rhino, they don't want to work with the team, they want to work with me, right? This is very, very, it's fine. It works really well for early stage, and it also works really well for high contract value. If you're selling something for $50,000 a year, you need to be the face of it, okay? So that's called founder-led sales. Product-led growth is, think of business apps like Slack, Zoom, Loom, which is like a screen recorder tool. Anything that's kind of like a free product where you get access to it, and then when you hit a certain threshold, you have to upgrade your subscription. This is different than premium and freemium, where you offer the product for free. And I'll just briefly go into that. With a freemium and premium is like, hey, I'm giving you these 2 features for free, but then you have to pay to access these 8 features, right? With a product-led growth, it's like, no, you get the product for free. Here's the full gamut. Here's Zoom. Like technically a free user and a paid user on Zoom is exactly the same. The difference is the consumption. Does that make sense for everyone for a product-led growth company? Again, there's books written about product-led growth. I just want to introduce the concept to you. Meaning your company is going to be completely dependent on product, the product growing and referring and acquiring customers rather than an individual, okay? Sales-led. This is for more advanced companies where they have 1 to 2 salespeople that are going out there, drumming up new business and closing those deals, right? So this is typically for more advanced. Community-led is something that's a bit hotter, but it's extremely, extremely good if you can activate it, right? If you can go and be like, hey, I already have a pre-existing community, I'm tapping into this, and now from here, I'm able to sell more product and reach out and all this other stuff, right? So as a founder at an early stage, you're probably at founder-led sales or community-led. product-led growth takes years to master and years to think. It's going to take some time. Sales-led is if you have a big enterprise push and stuff, right? So you're kind of at these two things.
Just to contribute, 3 quick points, and I will be quick. Number 1, community-led is arguably one of the most valuable and often overlooked channels here that you ought to be thinking about, because there's a difference between a customer and a fan, a customer and an ambassador. And so if you can convert a stranger to a customer, that's really good. If you can convert a customer to an ambassador, it's even better. If you can convert an ambassador to a fan who becomes an advocate for you, who sings your praises for free and creates viral organic content and recommendations for other clients and customers and other strangers to you to join, that's amazing. But think about that journey from going from stranger to customer to ambassador to fan. Community-led approaches can help do that, because people feel and people remember a feeling much more than they do a brand or a logo or an online digital experience. So think about how you're making them feel. Second thing I want to highlight in all of this when you're talking about GTM, particularly when it comes to founder-led sales and sales-led, is the difference between a pipeline and a pipe dream. A pipeline and a pipe dream. One is real and realistic and tangible and measurable, and the other is exactly as it says on the tin, a dream. So a pipeline is a funnel that you are actively managing, moving prospects from the top end of your funnel, from strangers to clients, and then hopefully ambassadors and so on, that can be measured. It's people you're speaking to, it's interested, quantified conversations in terms of deals, how hot they are, how likely they are to convert, and so on. That's a managed pipeline. A pipe dream is when you say, now we're in discussions with Nokia, now we're in discussions with Facebook. Google are really interested. I went to an event with Visa, suddenly they want to give me $1 million. That's just a dream. Now, it might happen that there are overlaps between a pipeline and a pipe dream. Your job when you're doing founder-led sales and or if you have a sales team is to make sure that there's less of the pipe dream and more of the pipeline. So when you are reviewing your pipeline every week, which you should be doing, particularly in B2B sales, you want to be asking, where are they in the sales funnel? What are the sales triggers or behaviors that they've showcased us that indicate that their intent is high and they want to move to the next stage of demo, of pilot, of letters of intent, of signing an MOU, or indeed of becoming a paying client. And you also want to qualify out. A pipe dream is, yeah, they really, really want our solution, but actually if you look back at the past 7 or 8 months of weekly reviews, they've been sitting and floating in the same area of your supposedly pipeline. That's a waste of your energy. Remove them, focus your energy on something else, and move them from the pipeline into that pipe dream bucket, ignore them, and focus on what is tangibly moving. In sales, a quick no is often better than a long yes. And the third thing that I want to highlight on here is conversion. Remember earlier I talked about growth velocity. Velocity of conversion, velocity of sign-up rates, velocity of revenue growth. What we're looking at from an investor standpoint is your ability to go from stranger to client fast. Whether you're doing that in B2B or B2C efforts, whether you're doing it in a sales-led approach, a founder-led approach, a community-led approach, we want to see the conversion. There's no point in doing something unless it's converting. Ultimately, all efforts lead to conversion. So what is your conversion efficacy rate? This is why the CAC to LTV ratio is important, but we can't get a CAC to LTV rate until we know that what the conversion efforts are and the conversion rates are, so that then we can define our CAC, our customer acquisition cost. So think about those things. Customers, ambassadors, and fans. Think about pipeline versus pipe dream. And finally, about efficacy and conversion. You can, from going from stranger to the customer.
Cool, thanks. I'm going to start burning through these slides pretty fast because we're on a big time crunch. If you want the slides, ask the organizer. She will send them to you. And then if you need to reach out, she can share my contact. It's ahan@growthrhino.com. I'm happy to book any time with anyone. I'm going to switch gears to talk about messaging funnels. Funnels is a very basic concept in marketing. There's top funnel and bottom funnel. You know, these are just, again, this is not the prettiest because of how it's stretched, but there's different frameworks around it for messaging. There's something called pain-oriented framework, which is like you're trying to bring up the problem as much as possible and really be centered around, it's called being pain-oriented, so that you're like, hey, do you have this pain? And you kind of position your product around it, right? And then you talk about the mechanism, and then you talk about the outcome. It's like, hey, if you have like think of a dental pain, it's like, hey, do you have a dental pain? Yes, I do. Well, we have a new solution. You talk about the solution, and then you say, if you use this solution, you won't have the dental pain, right? So like in 3 sentences, how do you go through this? The second thing is the GTM funnel. It's like a regular funnel, there's top funnel, which is awareness, interest, then you go activation. This becomes middle funnel, revenue, and then retention, which is more bottom funnel, right? So the thing here is like, how well are you moving the customers across the funnel, right? Is the thing. There's a lot of content out there to discuss this in significantly more detail, right? What I want to talk about is how do you align GTM with investor-ready traction. You need to link every single GTM metric, so every GTM goal to a metric. So what does that mean? It's like, okay, fine, if I'm going to go and drive, I use this example of qualified inbound volume, I'm going to go drive more leads. Well, how am I going to do that? Oh, I'm going to go hire a salesperson. I'm going to invest in X in marketing and whatever. Okay, fine. You're going to invest in X in marketing to get an increase of lead volume. What is the result of that? How much revenue or metric that we talked about in the first half, like how is that going to be influenced? So this is why I bring up capital efficiency from earlier. So I repeat that. The expectation is you're going in and you're like, hey, I need to increase these goals, and I'm going to use my go-to-market function to do that, right? I need to increase lead volume. Because I increase lead volume, I close more deals. Great. I'm going to spend $10,000 to increase my lead volume by 20%. If I increase my lead volume by 20%, I expect to close more deals, which could result in $100,000 in revenue, right? You need to be able to confidently, those are all made up numbers, obviously, but you need to be confidently talk about this in a conversational manner without opening up a spreadsheet and stuff. So you need to know your numbers and how it relates to the go-to-market function and what it actually executes, right? That's essentially what I'm talking about here on the left of like, you need to attach your GTM goal to every single metric, all right? Does that make sense at a high level, guys? Yes, I'm seeing some nods. Okay, great. The experimentation mindset, what Elliot was talking about. Experimentation, if you remember when you were in school, there's something called the scientific method, right? People in marketing has taken the scientific method and they're like, okay, how do you experiment? And now that's evolved to the founder mindset. From an experimentation perspective, there's this thing called hypothesis. What's your best guess that's going to happen? Let's go back to my example. If I take $10,000 and put it into marketing, what's my best guess? I'm early stage. I've never done this before. So maybe I don't spend 10,000. Maybe I spend 1,000. Like, okay, I'm going to spend $1,000 on ads. And I don't know what this will give me, but I anticipate it. It's not going to give me $1 million. It's not going to give me $0. Right? It might get me something in between, and I need to figure that out, right? So what's the hypothesis? What's the smallest test I can make? If I'm comfortable doing $10,000 tests as you get with the experience, great, do it. But if you've never done it, then you start small. That's a rational thing to do. I see founders are like, oh yeah, we're going all in on this experiment. No. It's an experiment. Why would you go all in on an experiment? It makes no sense. The whole idea, if you remember from science classes, is you do multiple experiments. Each experiment has a hypothesis, and if you identify an experiment that works, then you go all in, right? So that's kind of the objective here. Does that make sense for everyone? So it's this experimentation mindset which drives a lot of the growth. Because the thing is, you don't know what will work. Me as a domain expert, I don't know what will work. I come in with an experimentation mindset, be like, hey guys, let's try to do this. Let's put $5,000 here. Let's put $1,000 here. Okay, did we generate anything meaningful? Did any of that stuff actually convert into something, right? This is what we mean by the experimentation mindset. And then again, what happens, what was the cost of it, and you evaluate it, but does it actually improve your metrics? That's essentially what you want to be doing, right? Like, which experiments will actually improve your metrics? This is the question you need to ask. I'm going to skip this because for time, but essentially the exercise there is, how do you describe your ideal customer persona in one sentence? You can use AI for this function, but like, again, just think about your audience. If you come to me and say, my audience is every single marketing person in the world, be like, you haven't thought about this enough. A persona is something that's specific, but applicable to a very, very big audience. Meaning, okay, I'm going to target marketing professionals who are struggling in go-to-market because it's a new field and they don't know how to apply AI. Okay, that audience size is close to maybe a few million people. Great. I can add a geography to filter it down. But how do you describe your ICP? I can tell you right now, for Growth Rhino, we work with venture-funded companies. Specifically, we work with the revenue teams of venture-funded companies. That is my persona, right? If I want to take it a bit deeper, I'm like, we work with revenue teams of venture-funded companies who have small marketing and sales teams. If you don't fit those three buckets, I probably won't talk to you. Like, I'm obviously happy to do coaching and office hours, but as a client, we don't take anyone who doesn't fit that bill, right? So you need to get confident on how to describe your ICP. Okay, I'm gonna talk about channels. The biggest, and I tell this to his portfolio companies as well, they just get money, they've given them whatever, 100 grand or so. Then they're like, oh, I'm gonna do everything. Like, dude, you have $100,000, you don't have $1 million. That's not enough money. $100,000 sounds like a lot, but it's nothing, you know? From a marketing perspective, you know, like there's some of your competitors who are already in market for the last 5 to 10 years, they're probably spending $100,000 a day on ads. You know, so you need to kind of contextualize it. So what you want to avoid is like, hey, I'm going to do a bunch of these tests across different channels. What you want to do is select 3 to 5 of the channels that you want to experiment and put a lot of small bets on, right? Say, okay, I'm going to try Facebook ads. Why? Because my competitors are there and I think my audience is there. If you're B2B and you're doing stuff on like TikTok and Facebook, I'm like, what do you, like, that's a wrong, like nobody is going to make $100,000 purchase because they saw a TikTok video, right? From a B2B standpoint. Maybe if it's a B2C, like something for themselves, sure, right? Like a real estate, that's different. But from a B2B perspective, where there's multi-stakeholder requirements, it's not going to happen. So I've listed a bunch of channels here, and I'll quickly go over them. There's outbound, you know, that's cold outreach, cold calling, cold emailing, cold LinkedIning. Be like, hey, I saw you at a workshop, I think we should work together type of thing. You know, that takes a lot of effort. That works at the founder level if you can hire salespeople as well for that. There's inbound, creating a lot of content as well. So that's easy to do. My expectation for any founder is that they're doing this already and they're building founder brand, right? Community and partnerships is very much a long-term fix. I don't recommend that to everyone because not everyone knows how to maintain a community. Founder network, I think you brought up earlier. If you're coming from industry, what's the unique network you bring in, right? And how can you build that? And then paid advertising is ads, right? This is the laziest thing to do. I don't recommend it to people, and I'm like, do it as a last resort. And or you come if you really understand the world of paid. If you don't understand the world of paid, it's not something you should consider once you get your first set of money, right? Okay, so how do you choose the channel and test it? So, you know, this is kind of the loop here, which I call an experiment loop. You start with the hypothesis, you measure the outcome, you run this small test, and then you double down on what's working, or it's failed. You say, hey, I'm gonna run this experiment for exactly 2 weeks. It failed. I did not get anything meaningful. I did not get a single lead. I did not get any activation. I got crickets. It's great. Failed experiments are great. 9 out of the 10 of your experiments are going to fail. It's fine. You learn. It's iterative learning. You learn, and then you plan the next experiment. Be like, okay, this failed last time because I didn't write it in Arabic. Let me run the next experiment. Everything is the same, but let me do it in Arabic. See what happens. Okay, maybe it's a bit better. Maybe I have the wrong offer. Maybe it's the wrong link. Maybe the landing page looks weird. Maybe I use the wrong imagery. There could be countless possibilities. Nobody knows this. You just have, like, no person you hire will know this. You as a founder, you have to be curious and ask questions. And the more questions you ask, the more you have to think. And it's tough because you will come up with the idea and then you're like, hey, I want to rip it apart as well, okay? So that's what this experimentation loop is talking about. How do you find the right channel is, again, think about the average contract value. It's called ACV. If you're selling stuff for $10 a year, your channels are going to be more content, social media, like that type of stuff. If you're selling something that's $100,000 a year, it's going to be more relationship driven, right? So like you need it like conferences and stuff like that. That's where it's going to be. How long is your sales cycle? Again, if you're a consumer, it could be minutes. How long does it take to order something on Talabat or Deliveroo? Minutes, right? If you're selling enterprise software, one of the ladies was asking me about HR software for enterprise. That's a 120 days sales cycle. Completely different, right? Where do buyers already spend time? So this is a quick thing where you should just be spending channels. If a lot of your buyers are at conferences, go to conferences. If a lot of your buyers are at festivals, go to festivals. Simple as that, right? Like where are they spending? If a lot of your buyers are on Reddit, you should be doing more Reddit ads. Simple as that, right? And then how fast, this is really important, how fast can you get feedback from your customers? If you can do that, then you can help dictate the strategy, right? Again, more of a discussion thing. I don't think we have time for this, but something for you to think about. Which channel have you tried and like actually has sparked real conversation for you, right? All right, I think we have time for Zina.
Zina has been a long-time partner of Dubai CommerCity. We are deeply rooted in the community. Also, we have received investment from Oraseya Capital. So we have this long-term partnership, and that's what I want to present to you today. So basically, what does Zina do? We provide you with a digital wallet. So we are licensed by the Central Bank of the UAE under the Stored Value Facility framework. This basically means that we are able to provide our businesses with a digital wallet. So what stands us apart from any other payment solution is most of the payment platforms that you see out there, whether it is Stripe or any of the local players, will settle funds into your UAE bank accounts with a settlement period that can range from 2 to 5 business days. With Zina, you have a digital wallet where the funds are settled into instantly. So if you are an early stage startup that needs quick access to your funds, it is the quickest solution in the UAE market for you to receive those funds. So with Zina platform, you will have a centralized solution to accept payments in person and online. You can have a quick cash out of those funds, instant payment to your Zina digital wallet, and then you also can have instant cash outs to your UAE bank account if you do require to have the funds in your UAE bank account. You can accept payments in over 10 currencies, including all the USD, GBP, INR, Euro, and every currency used in the GCC region, as well as accepting payments with Apple Pay, Google Pay, domestic or international cards. Once your team starts growing, you can also add them on Zina and manage their access level so that everyone can have access depending on their on their position in your company. So when it comes to accepting payments in person, you can accept with Tap to Pay on iPhone and Android. So this literally allows you to use your mobile phone as a card machine. You don't need those traditional hardware devices anymore. You will just have Zina on your phone. You input how much you want to charge, and then the client will tap your phone with their card or with their own phone with Apple Pay or Google Pay, whatever device they use to, or whatever method they use to complete a payment, they can do so just by tapping your phone. Again, we are the only provider in the UAE to have this solution enabled both for Android and iOS devices. As long as your phone has NFC, it can be used as a card machine. And then alternatively, we have QR codes. QR codes nowadays are more of a backup solution in case your phone runs out of battery or doesn't have mobile connection, or you are at an event and you want to have different methods for clients to check out. You can also use QR codes. If you sell on social media, you can use payment links. These payment links are highly customizable, both from a branding perspective, where you can add your logo, cover picture, and you can also collect customer details like their email, their phone number, if you are building client lists, or you can collect delivery address. You can basically choose to collect any details from the customer, which they will have to provide before they complete the payment. Otherwise, if you don't have those options enabled, they will just complete the payment. And alternatively, you also have the Z-board. So everyone knows how you can, when you are texting on any messaging app, you can switch from English to an Arabic keyboard. The Z-board allows you to switch to a different keyboard where you can automatically generate a payment link. So if you are talking with your customer on WhatsApp or on Instagram or Telegram, you don't need to go to Zina app, generate a payment link, copy paste it into the messaging app. You can simply switch the keyboard, input how much money you want to charge, click send, and the payment link is directly sent to your client. And then probably the most suitable products for everyone here today will be a payment gateway. So if you have a website, you can simply install the Zina payment gateway on your website to start accepting payments. We have integrations with Shopify and WooCommerce, so in those platforms you can set up everything with a few clicks. Alternatively, you can also install it in your custom-built website. And then last but not least, we also offer a Zina API. So the Zina API aims to target platforms or apps that want to automate their payment flows. So this allows you to automate how you generate payment links, or to generate payment links on behalf of your customers, provide a digital wallet to your customers. So let's say that you are an accounting platform, you can allow your users to automatically link their Zina wallet to your platform, and you will start receiving notifications with their transaction details so that you can populate all the accounting and tax forms. You can generate payment links on their behalf. So basically, by integrating with the Zina API, this is very adaptable to your own needs. You can provide the different solutions that Zina has within your own platforms. And then we covered how you get money into your Zina digital wallet. So as initially mentioned, we saw in-person and online payment options. All of these options, whenever you accept the payment instantly lands into your Zina wallet. So settlement period is instant. Once the money is in your Zina wallet, you can directly spend from your wallet with the Zina card. So the Zina card will be a virtual card that you can use online or link to Apple Pay or Google Pay for in-person purchases. And alternatively, you can also cash out to your UAE bank account, and then from there, use the funds as you see fit. When it comes to open an account, Zina is a digital wallet. Our onboarding is completely automated, digital, so you can download the app, install. You will probably finish the sign-up process before I finish the presentation. So it is a very smooth, automated onboarding. No upfront costs, no maintenance fees. So it is, we charge a transaction fee. If you don't transact, you will not have any costs on maintaining the Zina account. There is no minimum balance required. So literally, you will just pay as you go. We have localized customer support, and our fee structure is 2.6% plus 1 dirham per transaction. And if your customer uses a different currency or pays with an international card, there will be an additional fee of 1.5%. As part of our ongoing partnership with CommerCity, the first 10,000 that you receive on your Zina wallet will be, the fees will be waived. So this allows you, once you get to a moment that you need to start accepting payments, if you use you have the QR code here, you have the link in the bottom. If you go to the Dubai CommerCity website, under the partner section, you can also find our partnership there. So I would advise you to set up an account closer to the moment that you need to start accepting payments. The offer eventually expires, so if you claim it now and you don't start accepting payments right away, it will expire. But the moment that you have your product market fit found and you want to start advertising and start accepting payments, then this will be a great solution for you to have a very quick and easy platform, licensed by the central bank, that will allow you to start accepting payments in person, online, and eventually, as your platform grow, we'll have more products that can complement that growth. So that will be it for today. Not sure if you have any questions. Otherwise, I would wrap it up.
How does Zena compare with the likes of Stripe?
So great question. So biggest difference probably goes in a fee structure. So here we charge for domestic cards 2.6% plus 1 dirham. Stripe will charge you 2.9% plus 1 dirham. We charge additional 1.5 for international cards or FX. Stripe will charge 1% for international card plus 1% for FX. So from a cost perspective, we have a cheaper solution, and then we have a more complement solution when it comes to methods to accept payments. Stripe doesn't have in-person payments, for example. When it comes to accepting in-person payments, so Stripe is more focused on online. You'll have invoices, payment links, payment gateway, which we also do. And then we also complement with Tap to Pay on iPhone and Android for in-person payments. And last but not least, Stripe is technically not licensed by the Central Bank of the UAE. So they do operate in the UAE without a license, which from a funds protection perspective might not be as secure. If for some reason your account gets blocked, you have less channels that you can complain because they are not licensed by the Central Bank, so you complain to the Central Bank and there is no real action that can be done. While with Zena we are licensed, so you can, if something happens, you have the specific channels that you can reach out to, and we also provide localized customer support. So if for some reason you don't speak English, or we do provide support in both Arabic and English. So we have different partnerships depending on the type of product that we are working with. ENBD is one of them. So we have ENBD, we worked with RAK Bank. We have different partnerships which we optimize depending on the different products.
Yeah, because that brings credibility.
Yeah, yeah. So when you invest, when your funds are in Zena, your funds are in what is called a CMA account, which is a big account that Zena has with a bank. And we are not allowed to touch those funds. So we cannot borrow your wallet balance to another person to provide a loan or a credit. So your funds will always sit in this bank account that Zena holds with our partner bank, and will always be accessible to you. So if tomorrow all of the Zena users would want to cash out their funds, those transfers will be processed to their respective bank accounts. Yes, so PayMob is one of the local traditional payment platforms. They don't have a digital wallet, so PayMob will have longer settlement periods. They are licensed by the central bank as a payment platform, so they will settle funds into your UAE bank account. With Zena, you have a digital wallet, so in the short term, Zena is going to start moving towards a digital bank. We are going to launch very soon, beginning of next quarter, virtual accounts. So we'll have an IBAN. You already have a digital wallet that you can hold funds. You have a card that you can spend from your wallet. You will have an IBAN that you can use to receive international and domestic transfers and process domestic and international transfers. Eventually, multi-currency accounts, currency exchange, remittances. All of these are products that we, with an SVF license, can launch, and PayMob will not be able to unless they apply for the license and eventually have the license granted. When it comes to fees, I'm not sure about PayMob specifically, but I will be 90% sure that their fee structure is similar to Stripe, just because it is the industry standard, is to charge 2.9% plus 1 dirham for domestic cards. So some players, for example, MomoPay will charge a monthly subscription, and they will provide you with a cheaper rate. So everyone can come up with their own business model. You as a business needs to understand how does it fit into your payment structure. Is it worth it to have a subscription payment, so a monthly cost that will still be charged in months that maybe you are not selling, maybe you have a strong seasonality. So it is always something for you to take into consideration, to compare not only the transaction fees, but all the other costs that are associated with that partner, setup costs, monthly fees, any hidden fees that might be added. So with Zina, we try to have as transparently as possible. These are the only costs that you are charged. There won't be any additional costs that you.
What about VAT? It is applicable, or?
There is, VAT is applicable, so we are, obviously we are tax registered, so we need to charge 5% on the fee. So if you have a domestic payments for 100 dirhams, the Zina fee will be 3.6 dirhams. We will charge 5% VAT on the 3.6 dirhams that you can claim back when you submit your tax returns. So the VAT, when the business then submits the tax filings, you can download all the tax invoices in the Zina app, and you can easily claim those VAT back.
And transferring from the card or the wallet to my bank account, there is any fee also? Or?
There is currently no fee. We are starting in July or August going to start charging a 1 dirham fee per cash out, fixed 1 dirham fee. So this comes because there are costs involved, and at the moment we are financing those costs. The goal is, being very transparent, there are two incentives here. One is obviously from our perspective to cover in a way the costs that we have with those transfers, and also to stimulate people to start accumulating more funds within the Zina wallet, because the goal from our side is that you use the Zina wallet once we launch IBANs, once we launch more products, that you start using or adopting Zina as your main account, and you don't feel like you need to cash out your UAE bank account. So it is going to be a fixed 1 dirham fee, independently of the amount. I think we have a question.
So you're linked with, like how to register, you're linked with the UAE ICP, like when we want to download or register our account, for example. How do you validate or do the due diligence on the...
So when you download the app, you either scan your face and Emirates ID, or you complete with UAE Pass, so that's how we validate you as a person. And then for you to open a professional account, we also ask for the trade license, memorandum of association.
And only for local UAE based?
We are only available in the UAE at the moment, so you need to have an Emirates ID in order to kick off the process, yeah.
We don't need a bank account.
You don't need a bank account, no.
I have license, I have...
If you don't need a bank account to open a Zina wallet, so you can just download the app. You need an Emirates ID. You can have access just with an Emirates ID to a light version of the account that is going to give you access to the different solutions to accept payments, but you will be limited on how much you can transact, and then those limits are removed once you completed the full onboarding with trade license, memorandum of association. That should be it. Okay.
Thank you.
Thank you guys for your attention.
We'll be moving to the next part, and then followed by question and answer session as well.
Okay, so the first thing is I break it up into 5 steps. So who exactly is your ICP? We talked about this. There's a good framework. I'm going to read it out loud. And it's like, my ICP is job title at type of company in this geography with this number of employees and revenue who's struggling with this problem. And they're using an existing solution. So the reason this is a good framework, take a screenshot thing. The idea here is extremely straightforward, where it's like, hey, this is who I want to go after, all right? So I think we talked enough about this. Does this make sense for everyone? If I can just, I get some nods. Okay, cool. Core problem and value proposition. We help ICP, which we've defined, struggle with specific pain to give this outcome with this solution, okay? This is very, very tough to do. What I like to do usually with teams is get co-founders together and tell them, hey, fill this out and then compare your responses. Most of the time it's not the same because there's different interpretations. If you get your different customers or suppliers to do this as well, extremely, extremely beneficial, because then you can see how valuable you are to the other organizations, all right? So this is all about value propositions and how you structure that sentence, but essentially what pain are you solving for that particular individual? Does this make sense for the most part? Yes? Okay, great. Primary channel hypothesis. Now, it's like, hey, I want to investigate this channel because I know these people here. I want to use Reddit because I see enough evidence that my customers are on Reddit and I think I should invest in it. What it's saying here as well is that, hey, because my buyer is like in Reddit and my average contract value is something like $50,000 and my sales cycle is 100 days. Okay, Reddit is not the best example, so I wouldn't use that for that. I wouldn't use it for a very large contract value and a very long sales cycle, right? But it's a good channel to investigate and understand what's going on. What I would really recommend here is do a deep analysis, look at your competitors. Very, very straightforward. If your competitors on LinkedIn, you should probably be on LinkedIn. Will you probably outrank them? No. But you should have some presence there, right? If you're saying, oh, my competitors are not on TikTok and I'm gonna go on TikTok, there's probably a reason your competitors are not on TikTok, right? Like, so you have to like apply some critical thinking there. What's important here about the primary channel is like you want to try to do some small experiments and try to find out what's the best channel for you. And honestly, I see a lot of people over-engineering. They're like, oh, we need to make like a crazy video ad the way Kareem did it back in the day. No. Kareem did that viral video 22 years ago. That was appropriate then. It was not appropriate now. Not from like a community perspective, but just from like an architect. There was not a lot of viral content 20 years ago, right? There was not a lot of content. Now we have a plethora amount of content, right? So you need to figure out what your primary channel is, okay? And the best way to do that is just look at your competition, look at your persona that we've defined in step 1, and then from there you're like, okay, fine, I should be at these particular initiatives or these particular channels. Does that make sense so far? Okay. Step 4, pick the one traction that you will move. Let's say if we use the B2B SaaS example that the gentleman mentioned earlier, my metric is MRR, and everything I'm doing is not impacting my MRR, I probably either I have the wrong set of experiments or I have the wrong metric. We know if you're a SaaS company, MRR is the thing that matters the most, but if you're talking to them about social media following, those do not correlate. What's your metric? What's your target? And why have you picked this metric, right? I'll give you an example, which is it's not really related to invest in fundability, but I can tell you for Growth Rhino, when we started about 10 years ago, this is 2016, 2017, we started off as a cold email agency. It was the hype of B2B SaaS at that time. Every single one of my competitors in cold email had a horrible website and had horrible SEO presence. Like, it was in comparison, right? So what I did was once I had enough liquidity, I had about $10,000. I took the $10,000, I gave it to my friend Ali. I'm like, Ali, I don't know what to do. Take this and make sure that we're SEO friendly, website looks good, whatever. I'm like, here's 10 grand, I don't care, just figure it out, right? My target at that point was, I'm like, I just want to be the best website and have the most amount of traffic in the cold email agency space for B2B SaaS, or B2B software, right? My metric there was really like, because it's SEO, if I measured month 1, I had 0 leads from SEO. Month 2, 5. Month 3, 10. It got to the point at that time when SEO was like a booming channel, I got to about 60 a month, okay? So my initial metric was, okay, I just wanted to beat my competitors. My competitors are like 100 or 200. I'm like, I just want to beat that. And then my target was, okay, if they're at 100, I want to be at 200, right? Same thing with case studies, right? None of my competitors at that time had like 3 case studies. You know what? I'm gonna have 50. So I got to 35, and then I'm like, okay, I'm okay with it, right? Like, I don't really care. But the reason that metric was important was because I was able to go into a sales call and say, hey, you're evaluating this competitor. How many case studies do you have on their website? 3. I'm like, I have 35. Okay. So I was using that metric. I wasn't using it for fundability perspective. I was using it for closing perspective. Okay. This is why your metrics matter. Does that make sense at a high level, guys? Okay, great. The last step, design your 30-day experiment, right? What does that look like? What's the test? What's the budget? Are you dropping $1,000, 100 dirhams, $50,000? What is that? What's the signal you want to mine and figure out, and how will you measure it? What's the go or no-go decision? You've got to make, it has to be black and white. It's like, yo, if we do not hit this metric, we either kill this experiment or we iterate on it. You have to be cutthroat about this. If you don't, oh yeah, we're running in this experiment, we're attending JITEX, we'll reactivate it. Like, you know, you keep lingering. You can't make any decisions, right? That's the importance of experimentation, right? We have about 8 minutes. This is kind of like, again, just maybe you can ask the organizer for the slides, she can send them to you. But this is kind of a summary, is like, what's your ICP, what's your value proposition, what channel, what's the metric you want to look, and what's the 30-day test. If you can fill this out, that's going to be extremely meaningful, all right? I'm going to open it up on Q&A. I have to bounce in 8 minutes. So thanks for attending. This has been fun. But if any of you have questions, I'll stick around and answer them. If you don't, that's fine as well. I think there's still some refreshments or something, I don't know. Does anybody have any questions? Yeah.
For a revenue-based company,
Yeah.
we have tried different methods of finding traction in terms of sales. One of the few things we've tried is LinkedIn.
Yeah.
Did not as part of the experiment. And one of the best ways we found is that through direct referrals from founder networks and also through brokers. In your experience, is there any other channels that you think works for this sort of business?
Sorry, what's your business?
Revenue-based finance, invoice financing business.
Invoice financing, very, 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 very tough here in this market. He's invested in one company, you should talk to him, it's called Aura. And the reason it's very, very, very tough is because some people want different types of investment models. It's not a mature product in this region. It's a very mature product in the West. It's not a mature product here. So if you call somebody, it's like, and they'll mix you up thinking that you're a lender as well. So I don't like, because I know this space, I've prospected in this space, I think it's more content and educational rather than brute force outreach. So your experimentation will be more around content, stuff like educating people on like the calculation is like, okay, fine, if you take money from now, how much am I actually gonna, like I have 30 days to pay it back, how much does that cost? Like you need to, it's more on the educational side. On LinkedIn though, you can definitely do more educational content and stuff and do that kind of thing. But on the brokers, if they have relationships, then you optimize for that because one broker might bring in 20, 30 pieces of business, right? I would optimize for brokers and channel partners in your business, and I would design an experiment on that. Like, how do you get more brokers? Give them a good incentives. How do you connect with them? Maybe it's on LinkedIn, maybe it's at events, maybe you host a dinner, whichever, right? But yeah, outbound is going to be very, very tough, and inbound it's going to be very stale and very, very competitive, right? And you have a lot of weird businesses that don't qualify for financing. So it's a tough GTM motion. I hope that's helpful. Any other questions? Yeah.
I see here in the this event that we discuss everything about the productive companies, like producing something, but you don't mention any service company. For example, I am a service provider. Like for example, I am a mobile repair and lab. I am just doing services.
Yeah.
What could be the best structure for the services? Except the feedback after customer.
Well, it's different for service. Well, you're retail, or you guys are doing B2B?
We are doing wholesale. Very closely, we are just launching a new project, just targeting individual, like starting a retail business as before.
Yeah, I think it's the angle there. Like if you're a regular traditional business, 90% of this stuff doesn't apply to you because your business is going to grow in a certain circumference of an area, right? The stuff I'm talking about here is how do you get to venture fundability? Usually a venture-backed company would touch or like a regular retail or mobile repair, unless it's like, oh yeah, we think we can get this mobile repair business from like whatever, let's say 1 million to 25 million, and this is the path. But a lot of that then it goes into private equity or bank financing or debt financing, right?
It's like that. We have started us from scratch. In 2 years, the company worth almost 45 million. But
Yeah, then what are you raising money for? You have the money.
I don't know. We have a private investors, like as you mentioned.
Yeah,
And
that makes
there's,
sense. It's definitely not venture funding. It's more private equity.
Yeah, it is.
Yeah, so none of this, on private equity, when you're more mature of a company, it's like, the assumption is you figured all this stuff out. You're a $40 million company. They don't really care. What they care about is your unit economics.
Yeah.
Can you continue to grow? How much does it cost? What's your payback period and all that? So for you, the metrics still apply. This go-to-market strategies don't apply. Okay?
Thank you very much.
Yeah. Any other questions? Going once? Going twice? All right, cool. Thanks everyone. Yeah.
Thank you everyone for joining us today. We hope today's session gave you a clear understanding of what traction really means, how investors evaluate growth, and how to build a go-to-market strategy that supports both. A big thank you to Mr. Elliot Denham from Oraseya Capital and Mr. Ehan Isaac from Growth Rhino, and our partner, Mr. Thomas Ribeiro from Zena, for sharing insights with us. Dubai CommerCity remains committed to supporting entrepreneurs through a series of workshops and ecosystem events tailored to every stage of startup journey. I'm delighted to announce that our next workshop, taking place on August 13th, will focus on understanding the key business metrics that investors look for while evaluate funding opportunities. Thank you once again and have a wonderful evening. Please feel free to stay back if you want to network. And we'll be sharing a small survey form as well, along with the feedback form. Kindly share your insights and feedback with us. Thank you so much.